G-Stash, here we are at the episode 1 of the SEDA Stash series, which is all about the full journey from fragmentation, modular blockchains, and our massive industry-wide journey to chain abstraction. We are kicking it off with an absolute bang. I think everyone's been following our camp series, which dove into chain abstraction, but one of the topics that didn't come up was universal inventory. I know it's a new topic for me. I'm very excited to dive in it, and joining us today for episode 1 is Mike from Nomial, as well as both the founders today from SEDA. We have Jasper and Peter. Just a little light background on the series for anyone that will be joining. We have also coming up Hyperlane, Kalani, we have Fastlane, we have RouteScan, EclipseFi, and we're going to be exploring the whole stack from deep within, like today's episode, focusing around liquidity, and then we'll be moving up the stack, finishing on user journeys and consumer crypto as well. So it's going to be a complete series across 7 episodes, I believe. So this is episode 1, very, very exciting. Mike, on that, let's hand over to you for a little bit of an introduction. How did you get started in all of this?
Thanks, Matt, and thanks for having me on. How I got started, we could start all the way back at the beginning. I was an active member of the Bitcoin community here in the Boston area back in probably 2015. So been involved in crypto for quite a long time. I was a co-founder of a company called Level K, a security auditing firm. Started that back in 2017. Worked on a company called Brink with my co-founder Andrew, and that evolved into what is today Nomial, and really excited to tell you guys more about Nomial and talk about universal inventory and chain abstraction and other fun topics.
Amazing. I'm excited to dive in with you because I think, Nomial is a massive solution to, a big problem that's going to happen as we scale this industry, app chain thesis and everything that we're going to dive into today. But you've personally been on that journey from the birth of Ethereum, basically, if that timeline adds up all the way through. So you've seen the whole thing. Before we dive into it, though, of course, I'll throw across quickly to the founders as well. Peter, what got you into this Web3 world?
Yeah, so we're building SEDA. It's crypto's most powerful oracle. Basically, millions of feeds, one integration. One thing that really caught my eye was Nomial's not clearing layer. So I'm very excited to dive a bit deeper into what that means, because we talked with Everclear in an earlier series. But yeah, also like Mike, we've been building in this space for a long time, building all the way from the application layer down to infrastructure now with oracles. And so I'm very bullish on what's to come with chain abstraction, all these different infrastructure pieces, kind of reimagining how users will interact with liquidity, and also all these different hundreds of chains that are being launched for different application-specific use cases.
Amazing. I think something that everyone's going to share in common here is that you're all builders for solutions that you probably needed somewhere along your building journey, and you found yourself here today because you're building the solutions that you wish you had 2, 3, 4 years ago when you were building at a higher level of the stack. Jasper, a little bit on yourself. How did you get involved in all of this?
Yeah, so I'm Jasper. I'm the CTO and co-founder of SEDA. I started on the investment side. I was building a company in the Web2 space at the time. And as I was building that company, a lot of the frustrations I had with the partners we were dealing with at the time would have been solved if it was built on crypto infrastructure. So I started pursuing sort of like the technological aspects of crypto a little bit further, and ended up joining this space full-time as an independent researcher, doing plasma research, so working on scaling Ethereum at the time. And yeah, met Peter at a conference, and we have been building products together ever since.
Perfect. Thank you very much. Yeah, it's very interesting to have all 3 of you here today as well, because I think it's fair to say, Mike, before we dive into Nomial as well, I'm just going to speak on behalf, that the solutions provided by SEDA, millions of feeds, one integration, any data, any network, and then Nomial with a universal inventory that we're going to explore aren't building specifically for chain abstraction, which is kind of the hot topic in the industry now, but are great solutions that fit within it. Well, they're not specifically for chain abstraction is what I want to say, but they're amazing tools that fit within the giant puzzle, the big collaborative puzzle that is chain abstraction. So maybe this is the best place to start. Mike, what is universal inventory? What is Nomial all about?
Yeah. So, yeah, to your point about chain abstraction, it's all of these pieces I think fit together to help this chain abstraction puzzle get put together. It's not all about UI tooling, like chain abstraction at the UX UI level. I think that's what people will see, and ultimately it improves that. But there's a whole stack underneath this that powers that, and we're part of that stack. So specifically, the problem that we're solving is for solvers and fillers and other agents. You'll hear them referred to as very different under various different terms. But it's a pretty simple problem, but a big one. So you have, as a solver in a multi-chain context, you need to front capital when you're filling orders. So when you're filling an order, you'll hear them called intents orders. When you're filling an order from chain A to chain B as a solver, you need to actually front the capital on chain B to the user. So for whatever size that order is, you need to hold inventory on chain B ready to go to fill that order. So if you think about the dynamics of this in a multi-chain world with 100 chains or 1,000 chains, the cost of your capital increases. The amount of inventory you have to hold increases incrementally as you add more chains. So if you're trying to fill, let's say, $500,000 worth of volume on every, you have to hold inventory of at least 500,000 on every 500,000 times 1,000. So this is a massive capital requirement. Even if you're a large entity that has the balance sheet to be able to handle that, like at a certain point, as more chains get added, it does become more expensive for you and your costs go up. So what we are building with Nomial is a way for these solvers to hold inventory on one chain and then be able to access inventory provided by passive LPs on every chain. So rather than having to hold private inventory themselves across 1,000 different chains, they just hold the private inventory in one place as collateral, and that gives them the ability to access from effectively liquidity providers on various chains. And we call this an inventory access layer. We're going to be publishing a lot more about this concept in the coming months. We've already written quite a bit about kind of the split between this role of market maker and solver. I think this is a really, really critical distinction to make. Right now, everyone kind of talks about solvers as if they're also market makers and liquidity providers and route finders, but we see these all as distinct roles, and Nomial really helps separate that role so market makers can do their job in the best way possible, and solvers can do their job in the best way possible. And we help connect the two and reduce cost of inventory. That's really the critical thing is reduce that capital requirement and that incremental cost as more chain support is added.
Yeah, and that's sorry, Jasper, go ahead.
No, that was me jumping in. You go, Peter.
Oh, sorry. I was just going to ask, so basically the concept is a little bit similar to what a cross is doing for bridges, where the solver, rather than having to bridge their inventory directly every single time and have it on every single chain, the idea is that at some point, basically an LP is earning yield for putting their capital at risk for a very tiny amount of time before it's resettled on that one chain where that liquidity lives. So if a solver is on, let's say, let's just say Ethereum is the inventory chain where all the capital is held, and that's where you have your collateral. And you want to fill something on, let's say, Near, and that's what's happening behind the scenes. Basically, then you have an LP who's willing to provide those funds on Near and have them resettled on Ethereum. Is that correct?
Yeah, it's so you're talking about rebalancing specifically,
yeah.
I want to address that because it's a separate category from.
That's why I asked, because I want to make sure I'm framing it correctly.
Yeah. This is so with rebalancing. That's a problem that solvers have where if your inventory is being depleted in one place, then you're getting repaid in another place. So you're using up inventory on chain B, and you're accumulating more inventory on chain A, eventually you need to rebalance. You need to move the funds from chain A back
Find
to
another
inventory
bridge to
on
bridge it
chain
back.
B. Exactly. And they generally do it through a bridge. We've actually heard they often do it with centralized exchanges for large volumes. You can actually like move it to a centralized exchange and then withdraw. That's a common workflow, rather than just using a bridge. If you're trying to do this with a large amount of funds and it's not time sensitive. But there's all sorts of things that solvers do to rebalance. It's super costly. We've got teams like Everclear solving this problem with the clearing layer and netting. I think that's like an amazing solution. And, we talk to that team all the time. We're building together with them. But inventory access is a little bit different. This inventory access is specifically, how do I get those funds in the first place? So if I'm a solver and I need to actually front capital, then that capital needs to come from somewhere. And kind of like the status quo right now is all solvers hold their own funds. So I'm acting as a solver and I hold my own private inventory. What we're enabling is for you to effectively borrow the inventory for a fee from another party that doesn't want to. You have entities that don't care about rebalancing. They hold a large amount of a token on some chain. They have an incentive to create liquidity for that token, but they don't want to do the solving infrastructure complex piece. That's a different role. So we're really splitting those roles. The rebalancing is something that has to happen regardless. Like solvers need to rebalance their inventory, but it is a distinct problem, and I hope that helps kind of shed some light on that.
I have a few questions. So it's essentially a multi-chain lending protocol to some extent, where you issue short-term loans on solvers so that they can fill positions on the destination chain, and in exchange, they get sort of like debited on a central layer, right? So is that how I understand it correctly? Like you have sort of like this liquidity layer where solvers collect value, and on the destination chains of intents or whatever you want to use this for, that having and sort of like a proof that you own a certain value within this liquidity layer allows you to get credit essentially on the destination chain for a certain amount of time before it gets debited on the origin chain or the liquidity chain. Is that correct?
That's very accurate. Yeah, that's a good way to think about it. It's effectively like an ultra short-term loan. Like in some cases, it could actually be like an instant loan that you're paying some fixed rate for, like almost like a flash loan, but across two different chains. Or it could be like on the order of hours. Like we're not talking about month or like 6 month or year long loans. These are very short-term access and repay. And generally the repayment on the solver side is going to happen when you're repaid from a protocol, like a cross, for example. So when you get that reimbursement from a cross, then you would repay the Nomial pool. And the Nomial pool conceptually is kind of a multi-chain pool. So it's connected with many different chains, and you could access on one chain and then repay it on another. You could also access it on one chain and repay on the same chain if you have a mechanism for rebalancing back to that
For
chain.
that, you need chain abstraction. So you do actually need a chain abstraction solution to some extent, right? Or like some sort of multi-chain account abstraction type solution.
Absolutely, yeah. And we're one other critical piece of this is that you do need a collateralization mechanism.
Yes.
Because it's not, unlike flash loans where you have a completely atomic environment, it's all happening within EVM, and there's really no counterparty risk. Like there is counterparty risk with this system. So you need the solvers to collateralize. And that collateral would be on a single chain. And then we need a system to like basically enforce that solvers repay. And if they default, then we use the collateral to repay. And this is all, it's effectively like a multi-chain app. And this is why, like, it fits into chain abstraction. It helps kind of the larger chain abstraction story, but we also use chain abstraction tools to build this. So
Yeah, very cool. Can the collateral be in an asset? So do I have to be collateralized in the asset that I want to short-term borrow on the destination chains as a solver, or can I be fully collateralized in ETH and borrow up to a certain dollar amount in sort of like destination chain tokens?
Great question. Yeah. So initially, it will be same asset. So if you want to borrow in ETH, you have to collateralize in ETH. But we want to enable collateralization in any asset. And for that, we need an Oracle solution. So this is a
Big
good
time.
transition.
That's where I was
what
going.
you guys are building. Yeah, we absolutely need Oracle in order to do kind of this multi-collateral, because obviously there's price risk there if collateral, you have to maintain that collateral ratio, and price reporting is what we would use to maintain it. But the simple version is like no Oracle design, same asset for collateral as for the borrow. But yeah, to answer your question, we're absolutely planning multi-collateral in the future.
Cool. I mean, you still need an Oracle for cross-chain sort of proofs, no? For it, let's say a solver needs to get liquidated on the Nomial chain, you need some sort of off-chain info or like cross-chain info.
Yeah, 100%. We don't plan on building our own transport layer, right? Like we're going to leverage existing transport layers and other proof systems.
Makes
but we
sense.
absolutely do need a proof system between chains. Yeah.
Can you help me understand this from the LP provider's point of view? I very clear from the solver side, but I had a play on your app before we did this podcast, or what you guys are building there. And so what I understand is that I can provide that LP. I can front I'm holding assets on whatever chain, tokens. I can put them into your pool, and then explain from the user point of view, where's that rebalancing come from? Where's the repayments coming from? What's happening to the assets for the user point of view?
Yeah, that's a great question. And the simple answer is, you're earning fees as an LP. Where those fees come from is from solver utilization. So when a solver utilizes the pool, they access or borrow from the pool, they need to repay. They repay with a higher amount that they repay with this additional fee. So you're earning fees when they use your asset. This is a question that comes up all the time. The pools won't be 100% utilized because you have, for different chains, you have different utilization amounts. Sometimes, like if you're not going to see like that asset being utilized 100% of the time, always like perfectly efficiently. Yeah. So we're definitely going to have like spikes of utilization and times of lower utilization. So the pool itself, if there is some sort of like yield bearing asset that can be held in that pool, the pool will hold the yield bearing asset. So like whatever yield you would be making outside of the Nomial protocol, you can still make that within the Nomial protocol in this pool. But when that asset's utilized, we can actually unwrap, use the asset for a short period of time. You get repaid with a fee. And as long as that fee is higher than what your API normally would have been with the underlying asset or the wrapped asset, then you're netting out positive. So for LPs, it's basically, you could think about it as you're putting your capital to use for intense space bridging fills. And that's like a super complicated thing to do, to build all that infrastructure in order to capture those fees. And there's not very many people in Web3 are doing that, and teams in Web3 that are doing that. There's a few. They're capturing all the fees. This is a chance for you as an LP to capture some of those fees passively.
Wouldn't it make sense to, on these destination chains, to sell this to DEXs as an extra service so that the LP pools that are being used for swapping at the same time can also borrow out some of their, or lend out some of their underlying collateral. So that you get sort of like one-sided added LP fees. This is because LPs are just getting screwed over, kind of, right? The fees are not super impressive most of the time. So this could be a super interesting sort of like addition on top of that to earn more yield.
100%. It's something we've talked to a few dexes about. I think like super powerful concept. So like if you're an LP in a dex, then you have periods of underutilization there as well. Like
Constantly.
if you could repurpose that capital for any other purpose and get any amount of fees generated from that capital, that's positive for the LP.
I mean,
so yeah,
there's even mechanisms you can think of where the LP pool still behaves the same and it trades as if it has full liquidity, but you still borrow out and keep like sort of like IOUs into the pool because you know that they will be filled back relatively shortly because of the sort of like the Nomial integration. I think that makes sense. It's just scary, so people need to have to really understand that the LPs will be paid back.
Yeah, I think go ahead. I was going to bring up just the protocol risk factor. It's like if you understand the mechanics of the system and how fees are paid back and the amount you'd be making for utilization, like it could be clearly positive for you. And the only risk is like, well, what happens if the solver doesn't pay back the protocol, and the protocol needs to be able to handle that. So effectively you're just taking protocol risk, but we don't want to introduce additional price risk to the LPs. It's like baseline protocol risk. They trust that the system that has been put in place, and they can verify this too, of course, has the capability of paying back the loans if in the case of default. Then it's as long as the fees are higher than what they'd be earning outside of the pool, then it's positive sum for them.
And it shouldn't happen, right? In the same way, like obviously this isn't an atomic flash loan, so it's not like the transaction will fail if the liquidity isn't repaid in that same transaction. But in most of these cases, there should be some collateral backing it just in a different spot, right? So even if there is like a short-term, called like under collateralization of this like short-term loan, at some point somewhere in that system, there is collateral from one of these solvers though, right? So a lot of that risk would be a temporary sort of like bridge risk, right? Where you'd have to then like bridge funds to that protocol. You touched on something a second ago around yield, and Jasper was alluding to this with, DEX pools. As an LP, sometimes one of the things that's frustrating is that you have yield, which can sometimes be fine, right? Like 10, 15% on lower risk, DeFi protocols that are more demand-based, right? So not with token incentives, but there's just a lot of demand on the pool, as an example. There's other times where that, demand drops off, right? And I think it'll be the same thing, when you have USDC, it might be pretty consistent with one asset, as an example, or just ETH. As you introduce more assets, that might change. I'm curious, like, just something that came to the top of my head, like, if you were to cap yield at, like, let's say 10% as an example on an asset, and yield were to go above 10%, and all that extra yield was put into a bucket, and when yield drops because the demand for that asset is lower, you can stimulate yield, basically, right, by increasing the APR and getting people to deposit or keep their funds in. Do you guys have any thoughts on like how you kind of create a more steady APR? Because I feel like that's the biggest thing for a lot of these LPs is like, where are we keeping our money and where are we parking it? Because one of the larger things that we look for is, and I'm speaking personally, not we at SEDA, but what I personally look for is just sort of like a consistent yield. And if the yield is going up to 50% and then down to 2%, it just isn't consistent enough to be able to be like a good strategy. So I'm curious, like, how do you guys think about sort of yield over time for these different assets and like sort of demand for them for more like long tail assets as well?
Yeah, that's a great question. I think so. for one, we absolutely have to compose these different assets together. Like, I think the LP example is a really good one. It's like, if we have a large amount of LP holders on a DEX on some chain, then asking them to like remove their LP, like take your LP out, put it in the underlying assets, and then put it in this Nomial pool that may, like, for the first 6 months of existence, be drastically underutilized. That's not a good value prop for any user, because they're going to be earning higher yield from the LP position itself. So I think, like, absolute necessity is that we are able to kind of dynamically use existing yield bearing assets for these. As far as spikes in utilization, I think if the pools were limited to a single chain, and these are like, the long tail chains, then we're going to see more spikes. What we ultimately want to build is a multi-chain pool, where by contributing LP on any chain in that pool, you're actually earning yield from utilization of that asset on any chain that it's connected to. And I think that will help smooth out utilization quite a bit, and make the yield more consistent. But in the beginning, it's really just about getting positive APY for LPs. And I think a lot of DeFi protocols, this is kind of like the standard design, is you create some vault, and you convince users to move their funds out of whatever they're currently in and into your vault. And that's not what we're trying to do here. Like, we're trying to repurpose existing yield bearing assets in anticipation for kind of like, some variable amount of utilization in the beginning. And then I think eventually we'll see much higher rates of utilization, especially as we connect more chains, as there's more app chains being deployed, just like more use across the board.
So in the end, what this does is it sort of levels the playing field for solvers, right? Like, you no longer need to have a ton of inventory on many chains, or you can actually solve with less capital, in theory, on many chains, because you don't need to spread it thin across many different L2s, right? And then the advantage of running your own inventory solution is just that you don't have to pay the LP fee, right? Like that's sort of like the only advantage that's left. Is that correct?
Yeah, exactly. You can think about, like, what's the cost of holding capital multiplied across every chain versus what's the cost of borrowing from existing LPs. And we very strongly believe that the cost of borrowing will be much lower. So regardless of your, as a solver, what your capital capabilities are, we believe that this will ultimately be cheaper. If you can connect LPs that want to provide this passive liquidity with solvers that need it on demand, it's much cheaper for them to just access where they need, when they need, for a low fee, rather than actually having to multiply the inventory across multiple chains.
Yeah, I also like, so I forget, I think it was in Denver. There was this chain abstraction day with One Balance and Across, and Hart was talking about with Across, basically you have, I think he said like $50 million in a micro loan or like a short-term loan for 2 hours. That was sort of like the risk window that they have with their optimistic oracle before it's repaid. 2 hours is obviously a long time if you can shorten that down to, a few seconds. I'm curious to know, for solvers, because I think this will be a very big thing. Like Jasper was saying, not only does it level the playing field for solvers, but it actually will probably help to decentralize the approach for solvers. Because, basically to run a competitive solver, we always have talked about this internally, like the citadels will rule the world for solvers, because they have the inventory, they have the cheap server costs, and they're able to just lose money or barely make money to dominate a space and then figure out how they're going to make money later on. And obviously, our ethos in crypto is that we'd rather not have one large company dominate, the majority of this. And one of the big things of chain abstraction always been is, yes, you're making it easier for the user, but you're sacrificing decentralization at the same time, because now you're relying on a solver to execute your intent for you. And so, having that solver stack be very decentralized is important. So I'm curious, what do you think about timing? Because I think for a solver, that's always the open question here is like, how much time is it going to be that my capital is at risk or at loan until I get repaid so I can redeploy the same capital again into another strategy? I'm curious, like, how do you think about that, having your own L2, connecting with other L1s and L2s as well? What sort of latency that you guys are aiming for with that?
Yeah, that's a good question. I think in a lot of cases, the solvers will be filling through existing protocols like a cross or potentially Uniswap X when that goes live for cross-chain, and many others. And these protocols do have some escrow window. So there's kind of like that baseline of like, I think that's like, you could say it's 4 to 6 hours. So you have a 4 to 6 hour window when the solvers will have to front capital. They are more or less guaranteed to receive the payment from that protocol. So in this case, the solvers would be not risking their own capital, with the exception of the collateral. So I guess they would be taking a certain amount of risk with the collateral, but they're utilizing capital from elsewhere. So I think in another case, which is interesting, we're working on something where potentially they can, this all happens within the Nomial protocol, and you have effectively the solver not taking really any capital risk over time. And like I mentioned in the beginning, think about like a cross-chain flash loan where the protocol is responsible more or less for like repaying itself from the user intent. So the protocol already has the funds and knows that it's going to be repaid. So it doesn't have to charge the additional time-based fee in that case. So this is interesting and something that we're going to be writing more about. But I like to describe it as a flash loan. Like I said, it's not atomic, but it is effectively like you're receiving capital on one chain and instantly repaying on another chain for some fixed fee. So there's no time-based fee or time-based risk there.
Right.
Yeah.
Yeah, it makes sense. Yeah, hopefully with fully customizable Oracle programs, you can get that time down to much shorter than 4 to 6 hours, somewhere in 30 seconds as an example, next quarter. One interesting thing that I'd love to touch on for users. I mean, obviously, the average retail won't be running a solver and might not be as technical, but it's quite interesting. Like I was filling out this investor form a few days ago of kind of like our outlook for like the year, kind of like founder predictions for their portcos, and one of them was like, what's going to be the killer app use case of 2025? And I put settlement and payments. And I think that, one really hard thing with yield has always been, where is it coming from? And with a lot of these platforms, it's usually like a token incentive, right? So there's some type of inflation, which is short term. Like you said, you have some boosted APY that, comes from someplace, but over time it dries up and the product becomes, not very interesting anymore for the average user. But what I'm hearing here is like, if you're serving as this sort of collateralization layer for solvers that will become more and more entrenched within transactions in the future, it actually is a very good use case for LPs and retail that are looking to get reliable, consistent yields on their capital without having to rely on token incentives as sort of like a main driver of the APR. It's really a demand-based APR, which I find very interesting.
Yeah, 100%. So you can think of the retail side as like the side that's contributing the capital, but the side that's using the capital, that's borrowing, is entirely based on these, like, they're infrastructure providers effectively. Like solvers are not retail. Like these are advanced infrastructure providers. So as long as there's demand for that infra, which really, as long as there's demand for fast bridging, then you have demand on the borrow side, and we're just allowing the retail side to take advantage of the activity there, which currently they can't do.
Yeah, exactly. Yeah, I think we first started talking, together back in 2020. That's like when we were first introduced, and I think that, even back then we thought, okay, there might be more than one chain with usage, right? Like at the time we were building stuff on Near. we knew that there was going to be more chains than just Ethereum. Solana and Near were in their nascent days at that point. Now you have the ability to deploy a rollup. Like we could probably deploy another rollup in a second, in the next 5 minutes during this chat while we're all talking, we could probably deploy our own rollup as well. And I think, what we're seeing here is developers and users are no longer evaluating the stack they're building on to justify building there. They're just saying, I'm just going to build where I have the best tooling and the best sort of reach that I have with users. And they don't say we have to build here because of X, Y, Z, because they're the only chain that fits our narrative. And I think that's really interesting because in the same way that developers don't have to now choose one monolithic chain to make a huge bet on for their users and their entire stack and developer experience, they can now build wherever they want to, but then have that liquidity accessible in a very easy way so that they can still build like a DEX or a lending product or whatever it may be, but have it be able to access a capital layer without having to make any sacrifices, which I think will be very interesting. So you're sort of doing the same type of modular extraction that we have with chains, but for liquidity for those networks to be powered. Is that correct? Is that sort of a good framing of it?
Yeah, 100%. And we've seen that the biggest challenge, like obviously it's so easy to deploy your own rollup now. Like this, there's service providers that can do this for you, or you can do it yourself with open source. Like the stacks are quite advanced. It's extremely easy. But what's not easy is bridging liquidity into this new rollup that you just deployed. So we're along with there's many teams that are working kind of along these lines, but I do think this all fits into chain abstraction. It's like if you want chain abstraction from either like user side or developer side, or just from all parties involved in interacting with these different entities, you need seamless liquidity across all of these chains. And just for a more like concrete example, if you launch a chain now and you want to service intent-based fast fills into your chain, you have to build your own solver. And that's not easy. There's no open source stack to do that. You have to interface with effectively like off-chain auctions. Like you're doing complex things as a solver, and there's a lot of teams that are very good at this, but it's not something that's even openly available to your average developer, like let alone a retail user. Like even your average developer, there's no like solver stack right now, which maybe there's an opportunity to build something like that. And I'd love to see that, and more standardization around solvers, of course. We've got like 7683 coming from like across in Uniswap. I think that's really good for the space. Like solver standardization makes it easier to interface with intents as a solver, but there's still no like easy way for me as a roll-up deployer, like someone who built an app chain and is developing there, to create to effectively like service my own intent-based bridge. That's something that Nomial is I think a good solution for, outside of just this universal liquidity, something like a little more like targeted to an app chain developer. If I'm an app chain developer, now I can just create a pool, put liquidity into that pool, that automatically services intent-based bridging liquidity. I think from a developer perspective, that's a really strong value prop.
Yeah, I agree for sure.
So just to help me as the only non-technical person on this call here, I'm spinning up a new rollup, and I think this is super cool. You spin up a new rollup, and the trouble, as you were highlighting now, is getting liquidity onto my rollup. But what you're just saying now effectively is that these developers that are spinning up their own networks are going to front that into their own pool with Nomial to front the capital, while they then attract people to come in and bring their own liquidity, like someone like me, for example, who might go, oh yeah, cool, I want to jump into their LP pool. So effectively what it does is like it takes that pressure off of them, these developers having to do all this marketing to try and attract people to come in, right? And they can sort of take that pressure off, get transactions, and we're sort of solving this chicken and egg problem, right? We talk about this at SEDA all the time, because data is one of those things that you need to bootstrap a new ecosystem or a new network. Liquidity is also one of these things. So what you're effectively doing is taking that out of the equation. Is that correct? Have I understood that correctly?
Yeah, absolutely. It's like you could think about it as either like what rollups are doing now is like forming partnerships with like a bridge team to provide some amount of liquidity and bridge there. But what we would be enabling is, well, now you can have community provided liquidity permissionlessly. So you're just like exactly like you said, like I deploy the rollup, I have this pool, and then I can encourage my community to provide liquidity there and earn fees every time someone bridges into the chain. So it's like, it's a good for the LPs. It's good for the community around my app chain. Any partners that I do have can also participate there, but it's not like the current kind of process for rollups bootstrapping liquidity is like go and convince a bridge to integrate, which is not. It's kind of like we're creating a new opportunity for your community and allowing this like permissionless liquidity. So yeah, we're excited about that.
Yeah. It's always been like mercenary liquidity, right? In the past, where it comes to a chain, it farms the tokens, it dumps the tokens, and it goes to the next chain. And I think, with Nomial, what you're basically trying to provide is the ability for a network to launch, and if the demand is there, it has access to capital, right? Whereas right now, you sort of have to find a way to park a bunch of capital on this chain using some type of airdrop campaign, sort of like, unannounced rumor that the L1 or L2 is going to do a huge airdrop, and anyone who provided liquidity on these network apps is going to get something. And you sort of change that dynamic, and you basically say, if there's real traction, if there's real users and there's demand, then liquidity will be able to access this chain very quickly. Where I think in most cases it's sort of like you have to park $100 million there to begin with across all these apps for users to even consider coming there and start trading. And I think that's been a big problem with a lot of these. We saw with most of the monolithic chains in the beginning that there wasn't really a big demand yet for users to come over because there just wasn't anything to do. And now, and why there wasn't anything to do was because there was no capital, right? And so it's kind of like this chicken and the egg. And I think that dynamic with chain abstraction and also with these types of liquidity layers really, turns the problem on its head. It's like as soon as the experience brings users in, they can start using it without having to wait 6 to 9 months to interact with all these different applications and protocols.
Absolutely. Yeah. I feel like kind of like holy grail scenario for chain abstraction is you don't have that dynamic of like moving to a chain at all. Like it shouldn't be like, oh, I'm moving to this chain to do a thing on this chain. I should be able to launch an app chain with some capability there, or launch an app chain with, let's say with a token. And then a user can use like Unichain to obtain that token, but through some tooling that they don't even see that this token is on this new app chain. I think that type of experience is like where this is all headed, where you're using an application on one chain to interact with assets on many chains, and the concept of chain to the user doesn't even exist. So I think that's where this is going.
Yeah, I think Nomial and SEDA have the exact same core philosophy, basically. In the same way, Nomial said, you guys basically said, if you want to, scale this, you have to be able to make this liquidity available to any network without having to deploy it to every single network, right? In the same way with SEDA, we said we need to make our Oracle feeds available to any network, but deploying every single network, is going to be like a huge undertaking, and it doesn't scale, right? So, when we were building our product a couple of years ago, that first party Oracle Flux, although we were number 2 in TVL, we said we can't scale this past 3 networks right now. It's going to be operationally way too heavy. And I think that, sort of that core DNA that a lot of teams I think have adapted is rather than deploy everywhere, it's like become accessible from anywhere, right? And I think that Nomial has that exact same DNA where you say, rather than deploy everywhere and get our liquidity spread razor thin across all these hundreds of chains, we just make this huge pool accessible when there's demand from one of these networks.
Exact same kind of progression at Brink. We deployed Brink on all different networks. We ran solvers independently on all different networks, and we kind of like saw where things were going. Like this kind of separate network deployment paradigm is not going to work, especially like when you're dealing with, I think we were dealing with about 10 chains, and that's already quite complex. And now I think there's like easily over 1,000 chain deployments, probably more like 10,000 today. If you're counting like every single one, I'm sure there's the number is quite high. It's growing all the time. But yeah, dealing with like 10 separate app deployments, dealing with 10,000 separate app deployments is prohibitively complex. So that's not the way that we see the future happening. And with Nomial, it's really like we're thinking about the Nomial protocol as a multi-chain protocol. There is an off-chain component as well, but yeah, it's not a separate protocol deployment on every chain. And I think that's critical, and that's a model that a lot of developers are going to follow in the future, because we just have to. It's the way that chain abstraction is playing out, and it's really like the rollup stacks that's enabling this and allowing developers to deploy rollups and app chains so easily. Like that's super rapid expansion, and results in fragmentation. And we're one of the teams that's solving that fragmentation problem.
Yeah, I'm really excited to see like because I felt like my entire timeline was announcements over the past like 3 days of like all these different chain abstraction partners we've been talking to going live with betas and mainnets, and I'm really excited to see like 6 months from now what the developer experience is like, and also for the user. I think like there's been huge leaps forward on both the infrastructure side and the user side to be able to really kind of build these more abstracted apps and experiences for users and developers. So I'm super excited to see where we are in like 6 months time when all these different solutions go live and are heavily used.
I think on that, I really hope that, we speak about chain abstraction. Well, not everyone, but the majority of people like to focus on this like UI UX benefit for like consumer crypto, or like the user on the application layer. But, one thing, and I know that we're very excited about this at SEDA, is improving the DevX. And just as you guys were talking then, I just realized like there is this big shift that's happening, right? You guys are close with Particle Network. They're one balance, any chain, right? SEDA, one Oracle infrastructure, any chain. You guys are effectively doing like one LP, any chain, because that's what it feels like for the user's point of view, right? Is like they're not going to have this concept of chains. So when we go 6 months from now, and I think this is very much part of SEDA's North Star, which is, unrestricted on-chain development. That's kind of what we're building towards. We're doing it for data. You guys are doing it for liquidity. Particle's doing it for, balances across any chain. Is creating this DevX experience that just feels like one environment, right? Because I think, Jasper and I have spoken about this with Enzo Finance and Socket as well, is this idea of I'm a developer and I just want to build an application. I just want to build a really great experience, but now I have to go and learn about liquidity. Now I have to go and learn about this chain, its functionalities, and now I have to go and find out where the users are, but I wanted to build on this chain, but account all these other things. So I think 6 months from now, or, maybe more, who knows, that's really what we're building to, is like one tool stack, any chain, and the developers can decide where they want to build. But the access for the user, which could be a developer in this case, is really any chain, which is what we get excited about, Mark. Actually, you and I have been DMing about this a little bit, of this concept of universal tooling. And I think we're moving away from that. We've done the era of tribalism. We've done the era of like maxis. Now we're just industry maxis. We're just all bullish on the on-chain development, which is, I'm even more bullish now after this conversation. I think that was one of my favorite episodes. I've learned a lot. We are coming up to the end of the hour. So, I mean, I've got 1,000 more questions. I wanted to dive into what you see the future in the app chain world. But I know a lot of people probably want to get involved, because you guys are, looking for new users right now. And how does anyone who wants to, maybe front their own liquidity, what's the best process for them to get involved in Nomial?
Yeah, so right now, the best thing to do is just join our community. You can do that on our Telegram group. I think the link's public on nomial.io, so you can just join the Telegram. We welcome you in there. Ask any questions you'd like. We're happy to answer them. We do have a signaling app that you can use. that is connected to a handful of chains now. We're going to be expanding that quite a bit. And yeah, just follow us on Twitter, Nomial_IO, I believe. And we'll be announcing a lot more there, kind of the design of the inventory access layer. We're really trying to build this in public, gather a lot of feedback from teams like SEDA and others, gather feedback from the community, and just like be transparent about what we're releasing as we go, different architectural designs that we're thinking of. We've already gone through a few iterations and gotten some great feedback from folks like yourselves, and really good ideas on this call as well. I think we talked about a lot of interesting stuff that hopefully will make its way into the protocol over time. But yeah, the best way to get involved now is just Twitter, Telegram, the signaling app. Engage with us. We're happy to answer any questions that the community has.
100%. I'm really excited too to keep working with you guys, and sort of telling your story as we tell our story, because I think we're all working towards what we was just talking about. We're all working towards this one idea, and I'm super excited to have you on today's space, and then also do some more content together in the future as we both keep building. But on that fact, Peter, Jasper, Q4, what's going on? Any spills? You guys are the sieves, the alpha sieves at the moment, leaking left, right, and center across your Twitters. Maybe it wasn't the best wording, but I went for it anyway. What's happening over at SEDA that people need to know about?
Yeah, I mean, I think the biggest piece is that we, have been onboarding a ton of RPC providers to make sure that, basically products like Nomial have a way to, settle and verify these different intents across any network. So we've been, heads down. I think we have like over 50 RPC providers in our pipeline. So the day is just basically call, trying to get some data proxies spun up with more RPC providers in our DevNet. We had some exciting news pass our engineering channel yesterday. If you follow our GitHub, you can see more of what was released last night. We're getting really excited to basically get some of these integrations that we've been building kind of in stealth with this, interop and chain abstraction focus live on DevNet, and get ready for the next month and a half as we get ready for mainnet.
100%. If you are GitHub illiterate, feel free to tune in on Monday. I'll be dropping a full report on what Peter was alluding to there. Mike, Peter, Jasper, thank you, all three of you, for your time. It's been an amazing hour, and excited to follow the story of Nomial alongside the development of SEDA. Thank you so much.
Mike, it was a pleasure.
Thank you, Mike.
Thanks, guys. Thanks for having me on.